Okay, Assalamualaikum warahmatullahi wabarakatuh. Welcome to your first recorded lecture for the semester. So this is the first topic that you would actually learn about audit completion. Okay, so audit completion, what I'm going to talk about is that now you have done your audit planning, you have done your field work. So what will happen during the audit completion? Alright, just to recap back what we have learned in the earlier class, I did talk about audit quality, I did talk about financial reporting quality, but of course from the perspective of external auditors, we are more concerned on the audit quality. So these are the factors that in general would actually influence the quality of the audit. So of course, first thing is the auditor itself. Alright, auditors must the most important auditor must be independent, and auditor also must be competent. And then secondly is the audit process. Okay, audit process will also influence the quality of the audit because nowadays the process evolved a lot. Okay, because last time we used a lot of traditional audit whereby everything is done manually, document is seen hard copy and so on. But nowadays with the evolution of the data in the company, then the audit firm has already been started using data driven audit approach. Okay, so a lot of data analytics has been done, testing is being done on the uh, population. Okay, so together with the risk-based audit, so now the way that how people do audit is actually a bit advanced compared to the traditional audit. Okay, so of course more interesting insights from the audit has been found, okay, by using extra tools in the audit approach. And thirdly, of course, the firm practices. Okay, so, in specific, it will be touched when we cover ISQC1 later on. But in general, what is actually firm practices referred to will be the practice of the partners. Okay, what is actually the attitude of the partner, how the partner handle cases, audit engagement, etc. Okay, at the same time, partner will also influence the management style within the firm practices, the audit approach within the firm practices, and also the selection of the client, selection of the auditors, and so on. So all this would actually influence also the audit quality. Okay, when we talk about audit completion, okay, this is actually in general what will happen. Alright. Now we are looking at the company who has financial year end 31st December 2020. Okay, so if your financial year end 31st December, by right your account should be ready latest by 30th April. Okay, because now SSM only give a company 4 months after they close the account. Within that 4 months, it has to be audited. It has already been presented in the AGM, okay, table to the shareholders and so on. Then you issue your audit report. Okay, so what will happen is that you would do, of course, sometimes you do your interim audit before financial year end, where you do test of control, you do IT audit on the system of the company, etc. So normally you only come after year end just to settle your final audit. Okay, we call it final audit. So of course you have done your audit planning, you have done your field work. Okay, and now you already completed your auditing work. Okay, so what will happen is that, all right, during the final stage, after you have done your field work, before the issuance of the auditor's report, there are completion. Okay, so there are some procedures that need to be done, normally being done by the senior in charge. Okay, because it involves a lots of valuation, a lots of judgment, and your discussion with the top management of the company, directors, board of directors, okay, managing directors, and so on. Okay, and sometimes it also involves sensitive issues. All right, so therefore this is normally done towards the end. Okay, just to wrap up the whole file, because we want to ensure that the final audited financial statement is actually reflect through a fair view of the company. Okay, and then of course after that, once you have completed, then you will send the account for a signing by the partners, by the directors, and so on, and you will issue your auditor's report. So you would have the date of the audit report. Okay, so that is one cut off date. All right, and then after that you will issue your client will issue your annual report. Okay, so that is also again another cutoff date that auditors must take note. Okay, because what happened is that a lots of things could happen in between those dates. Okay, a lots of things could happen in between those dates. All right, between your financial year end, which is your first cutoff date. Okay, because your account is reflecting financial position, okay, income statement for 31st December 2020. But there are things that happen after year end which could have an impact on your financial statement. Okay, on your financial statement that you have audited. So as an auditor, what is the audit procedures that you need to do? First thing. Secondly, okay, what would be your conclusion on your audit opinion? Will it change or will it remain or what? Alright, so that is the responsibility of auditors need to be considered, okay, when we're talking about audit completion. Okay, it doesn't mean that when you wrap up, sign the accounts, that's it, your work stop. Okay, so there are duties and responsibility that auditors need to know with regard to certain procedures that need to be done, even though beyond, okay, your financial completion of your financial audit. Okay, so what we're going to cover here will be, we are going to look at the contingency. Okay, we are going to look at the accounting estimates, okay, disclosure, and then final ethical review, engagement quality review, subsequent event, and going concern. So these are the key elements that normally we will look at during audit completion. So lots of assessment, lots of judgment and decision making need to be made by higher level. Okay, is involve both partner, those who's concerned with the corporate governance, such as board of directors or the committee, as well as senior in charge, of course, and partner. Okay, right, let's look at the first one. Okay, contingency, reviewing of contingency. Contingency is actually talking about contingent losses that are probable, reasonably can be estimated, and it is actually remote. Okay, meaning that there are possibility that you know that it is going is possible to occur, and you can actually estimate. Okay, you can come up with the probability how much to estimate for the amount. Okay, in order to be disclosed or to be adjusted in the financial statement or what. Okay, so what are the example of contingency that could happen? Of course, in year 2020, we have a lots of COVID. Okay, so that is one of the lots of things that happen after year end, especially for the financial year end 31st December 2019. Okay, other than that, other example of contingency would include threat of expropriation of assets in a foreign country. Okay, so what happened is that this is for multinational corporation. You are doing your business in, let's say, what is this? US, all right, and then now US and China is not having a good relationship. So at one point of time, you're actually being required to move out from US. Okay, so you have to take out all your assets, okay, from your foreign country. So what will happen to the financial statement of your company? Okay, and sometimes you have litigations or claims. All right, so when we're talking about litigations, that sometimes you are being sued. Okay, you are being sued, therefore you have contingent liability with regard to that. Okay, however, sometimes litigation might take years to settle. Okay, so from time to time you have to update what is the status of the contingency, okay, or litigation, and what is actually the amount of the liability that you would be exposed to from that litigation. Okay, because basically in the notes to the account, if you have that case, you have actually to explain what is actually the nature of the event, what is the implication to the financial statement, to the company, and what would be your provision of liability if you have any. Okay, especially when the case have come to the close to the end. And then guarantees of debts of others. Okay, when you become guarantor, okay, this is quite common for holding company, right? When you have subsidiary go into the business venture, and sometimes they taken up certain loan with the bank or through the syndicated loan, and of course bank will ask for guarantor. Okay, so most of the time you as a parent company, because parent to the child, normally parent will become the guarantor, isn't it? So as a parent company, holding company, you actually issue the letter to the bank that you would be the guarantor. Okay, so if anything happened to that subsidiary, you actually will be liable. Okay, so if there are cases whereby you become guarantor and something really happened to your subsidiary, now you have that amount of liability that you need to be liable. So again, this also need to be disclosed. Okay, obligation of banks under standby letter of credit. Again, this is similar to guarantor to the debts. Okay, you facilitate. Okay, because sometimes you taken up credit facilities from the bank, and if you fail to do whatsoever, you have some liability exposure. And then agreement to repurchase receivable that have been sold. Okay, what is this? This is actually factoring. Okay, factoring, meaning that some company also practice this in order to manage their working capital. What will happen is that for them to wait for the receivable is actually your customer, right? So for them to wait for their customer to pay is taking them so long. Okay, so what they actually do, company would actually sell their receivable to another company, okay, to the factoring company who would actually buy this receivable. All right, so they will buy this receivable normally at certain discount. All right, and sometimes in certain agreement you have actually made an agreement to buy back that receivable from that factoring company on certain date. So it's already a commitment. Okay, it's already a liability for you to must be able to come up with the money. Okay, because when you sell to the factoring company, they will give you amount of money, isn't it? Okay, so of course now when you want to buy back, you have to pay them. So it is actually liability on your part. Okay, so this is also another possibility of contingency that could happen to a company. So what will be the responsible, okay, for the auditors and management? Of course, all these things is actually managed by the management. Okay, so and normally known by the CEO or CFO. All right. So as a management, they must be able to identify what are the contingencies that happen in the company, because most of the time, all these contingency event is not reflected in the financial statement. Okay, as at year end. But you know, these are the possible liabilities that company is actually facing. All right, so that's why they must be able to identify, they must be able to evaluate and account. Okay, account for contingency, meaning that substantiate the amount. Okay, in terms of my value, how much is the value of the contingency. So what as an auditor need to do? As an auditor, you will go and ask the client just to confirm. Okay, is there any contingency that company or client have? And if they have, then you must be able to identify how much is the amount which is accounted for, and you also get all the details in order to disclose all this material contingency in the notes to the accounts. Okay, so these are the audit procedures that auditors must do. Okay, so you go and ask and get all the information, quantify, and do some citing. Okay, because normally you would actually have some documents that you need to know, because sometimes client also forgot, oh, we do have this contingency, so we always want to double check. Okay, so be auditors, you always skeptical. Okay, so what are the other sources that you might found? Okay, company is actually having contingency issues, because sometimes client don't know this is actually contingency issues. So as an auditor, what you need to do, you would actually look into client's legal counsel, correspondence, claims contracts, debt governance, and so on. Okay, so basically you need to read all this, go through all this. Okay, whatever correspondence. Nowadays, correspondence is all email. So how you want to get access to all those? Okay, and of course contracts you have physical or even sometimes PDF copy. Okay, but still you have to go through page by page to identify if there is, especially construction company, if let's say you fail to deliver, what happens to your obligation or your liability exposure. Okay, other than that, okay, additional sources would be corporate minutes. That's why normally before you sign your auditor's report, especially for listed company, okay, you would actually ask to go to company secretary and do additional citing of corporate minutes of board meeting. Okay, remember when you do first thing when you do your statutory audit is before the beginning of the audit, isn't it? So now before you sign the account, you will still go to the company secretary and do the citing of the corporate minutes of the board's meeting, because you want to see, is there any significant decision being made that would have exposed company to a certain liability. Okay, again contracts, again correspondence. Of course, last time is that we just ask for the file of the letters, correspondent, but nowadays because of the email and so on, so you have to able to get access to all those things. Okay, correspondent from the government agency and so on, and also plus the bank confirmation, because sometimes bank confirmation also will tells you additional liability that is exposed to, especially in terms of credit lines. Okay, so the bank confirmation is not only to confirm how much is the balance of money that the company have inside the bank, but also facilities granted to the company. What are the credit lines that given or credit facilities that given to the company would actually have impact, okay, of liability exposure to the company. So these are some of the audit procedures as an auditor that need to do. So after you have done all these procedures, okay, as an auditor, what do you need to do? You have to consider two things. One, do you need to make adjustment to your financial statement, or you have to make disclosure, okay, in the notes to the account, or do nothing. Okay, so